Hey TA, welcome to the show.
I'm happy to be here.
So you're three times entrepreneur. You're currently managing director at Pioneer Square Labs. Uh, you also hosted two podcasts, and I want to talk all about that. But before that, you were also a professional sailor. So tell me a little bit about how did you become a professional sailor?
Well, I grew up on Lake Michigan outside Chicago. And so my parents had a boat, and I was always hanging around the beach or hanging around the yacht club. So from a very early age. And I'd started sailing, boats off the beach and racing a little bit. My mom was actually a sailing instructor. And at one point, when I was about 13 or 14, one of the teams that my parents knew, invited me to go along. And so I decided to try it out for a weekend, and that got to be pretty interesting. And then I kind of got moved up on a couple of teams, sort of drafted in the local yacht club, to the better and better team. And then ultimately we became kind of one of the best teams in the Midwest. And I did that all the way until I went to college. And but as a kid, so that was like one theme. The second theme was, as a kid, I'd had this dream of doing this round the world sailing race. And so after college, where I took a break from sailing as I went to college on a swimming scholarship, I wrote a letter to a couple of people that I'd met along the way and said, "Hey, I want to go do this round the world race. Here's what I know so far about sailing. Is it something you can give me some advice on? Could you tell me what I need to learn? Could you make some connections on my behalf? Sort of maybe what any entrepreneur might do today if they thought they might like to go start a company." And those people were generous enough to help me, both in terms of offering to make introductions, giving me sort of what I might learn. But they also said, "Hey, we're putting together this professional America's Cup team at this point in time. Would you be interested in trying out?" So it was a total surprise that I got a tryout. I went and tried out the first time, got passed over. I tried out the second time, got passed over. And then one of the people they really wanted, who was better than me, didn't show up. They chose a different team. And so I effectively got drafted out of the minor leagues to join this particular team. And then it's a little bit like joining a successful startup when it's small, and then it goes on to IPO. And in that particular case, we went on to win the America's Cup. And so I went from having little to no experience to being part of a successful America's Cup team. And then just like being part of that IPO, effectively your stock goes up, your awareness goes up, your connections go up. And then I continued in the professional path after that 1992 America's Cup.
So how long were you a professional sailor, and at what point like you sort of switched into entrepreneurship?
Yeah, so I was an entrepreneur before, so I'd started a couple of companies when I was in high school, both a yard maintenance company and a boat maintenance company, and even a soap company while I was still in high school, working around the docks. But I quit my regular day job in 1990, and then I was really full time professional sailing until really the fall of '95. So call it 5 or 6 years. And what was happening in '95 is the internet was starting to happen. And people were starting to build websites. And so I would sail during the day, and I would sit around drinking beer with people at night. And people would ask me, I was sort of like the technical guy around the yacht club, like, what's going on with this whole internet thing? Like, should we have a website? Should we, be thinking about this? And so I started building websites on the side for a lot of the people who were either owners of the teams I was sailing for or other people in the industry. And so in '95, '96, I was sort of sailing by day and building websites by night. And that was a slow transition out of sailing and back into entrepreneurship and technology.
So that translated into Senosis.
Oh, that's like 5 companies later. I mean, Senosis was my last company. So that transition moved from sailing to a company called Soft Labor.
Mhm.
That was a web development company. Then that moved into HelpShare, and that was my first real technology startup. And we raised some external capital, and that company actually failed. So that was my first real attempt. It failed during the dot-com crash. And then I ended up at Microsoft, and then from Microsoft were many, many of those other sort of startups. So Senosis was the most recent one of that long journey of founding 5 different companies and having 3 successful exits.
So I looked at your chronology in the wrong way then, because I
Yes.
thought Synosis was the first one and Rival IQ was the last one.
Nope.
But so you went on to start Rival IQ and then Gist and then Synosis. Is
It
that
was
the right chronology?
actually it went from so I left. I was at Microsoft for 3.5 years, and I worked a lot on the exchange team. So I learned what real enterprise software felt like, the global market, real impact, hundreds of millions of users, things like that. But you don't know when you're just doing your first real startup. You don't know what scale looks like. I didn't even know what the functional jobs were inside of a real company. But Microsoft was a little bit too slow for me, and so I left and ultimately started working for Paul Allen, and we built a startup studio in 2006 for Paul and started generating ideas and validating those ideas. And one of those ideas was a little bit similar to what I'd done at Exchange, and it just captivated my attention, and that ultimately was Gist. So I left Vulcan Labs to start Gist, and we worked with Gist for about 2.5 years, and then sold that to Blackberry. And then nearing the end of my earnout at Blackberry, I met some friends along the way, and we started working on Rival IQ. And so then I left Blackberry to join Rival IQ. And then at some point in time, like, I started getting really interested in this health category. And that led to founding of Senosis. And then Senosis was relatively quickly acquired by Google for its team and its technology. And so that was more the chronology of Gist, then Rival IQ, then Senosis.
So after that, you joined PSL, or you started PSL?
I joined PSL after we sold Senosis. So I was an early investor in PSL. I've known all the founders for a long time, having built many companies here in Seattle. And when I was actually starting to work on Senosis, they were starting to work on PSL. And coincidentally, we were sitting across from each other in a very big and empty co-working space, literally, across from each other. And then after we sold Senosis, I was thinking about, I'm just going to go do another company. At that point in time, I reached out to Brad Feld, who was an investor in Gist, who I'd worked with in a lot of different contexts, and I really value his opinion, both as a investor, a mentor, a board member. And Brad really gave me the insight to say, hey, you've done a lot of companies on your own. Maybe you should spend a little time with a lot of companies instead of a lot of time with one. And it really encouraged me to think about PSL as an option. And he's one of the largest investors in PSL. And so, long story short, I chose to join both the founding team that was here, which they were already a couple of years into it, an opportunity to continue to work with Brad, and an opportunity to see what we could productize from an entrepreneurship perspective, having done it a number of times myself, as well as spent a lot of time with Techstars companies, as well as done a lot of angel investments. I thought that I could come to PSL and continue to productize the function of doing early stage technology-based startups.
So this is Brad Feld, who wrote the book Venture Deals, right?
Correct.
Yeah.
Yep. One of the co-founders of Techstars, Venture Deals, a number of other books. Prolific blogger, amazing human. Period. Just such an amazing person to be involved with. And any chance you get to work with someone like Brad Feld, definitely jump at it. And this was one that had a lot of combinations of things: of Brad, the founding team of at PSL, and the sort of functional work that we do at PSL.
So, I mean, you started, more than 5 companies. What made you start from one company to next? Or what is the decision factor in terms of finding the opportunity? Was there any common pattern, or some of the things that you used to, I think this seems the right opportunity timing wise, or just the momentum wise? Give me a little bit of what was that decision making process like?
Yeah, I think as you mature and as you do more companies, right, you develop your own decision-making framework, as it were. In the case of Gist, it was I felt like I could see the vision for the product, and the first crappy little bitty product was really quite cool, right? So I would say it's a technical insight that said, is this possible? can I prototype this? And is the prototype like, oh, that is cool, and I think somebody else is going to want that. So those were two things that kind of worked to get GIST going. What made Rival IQ go was I had four of us as a founding team. We were basically saying we want to do something together. We hacked around on a bunch of different ideas. We started to get some momentum on this idea for Rival IQ, but we all said, hey, let's not quit our day jobs until we can find 5 paying customers who want to pay us at least $200 a month for the thing that we built. And so it was, we didn't know whether that was going to take a day, a week, a month, a year, or never. But I would say this is a side project with people I wanted to spend time with, that we kept working on that side project, or we would have worked on a different side project until we found, I'll say, customer traction or customer pull. In the case of Senosis, this was also really team oriented. So the team that really was part of the founding team at Senosis is at University of Washington. They had some very cool technical innovations, and they were looking to try and turn that into a company. And they needed kind of a CEO persona to add to the other people that were around the table. And so that was a blend of team and technology that got me excited about it and market opportunity. But as we think about the ideas that we do at PSL, the majority of them are, when do we know it's a good enough idea, is really largely around all the customer discovery, customer development process type of things. And that's been an important part of what we do at PSL.
So, I mean, there are a lot of ways for founders to start companies. One of the ways is, you raise a venture capital, or you bootstrap it, or you join a venture studio or a startup studio like PSL. So in your opinion, why do startups choose a venture studio? And there are different types of venture studios. I mean, you could call YC also one version of a venture studio, or an accelerator. But why choose that model? And then, what do you see as the unique factor that founders come for PSL?
Mm-hmm. Great. Let's first separate, I'll call broadly, an accelerator versus an incubator. So an accelerator like YC or Techstars, they are cohort driven. They are usually finite in time, and they are what I would call heavily advice centric. Right? You go there and people say, like, you should do X and you should do Y, but they don't do really any action. Like, they don't do anything. They just tell you should go do something if you're the founder. And I've been involved with Techstars really since year 2 of Techstars, very involved with Seattle and many other programs. And I give lots of that advice. Hey, here's how you should go do some customer discovery this week, or here's how you can think about pricing, or here's how you can think about go to market, or here's how you can think about your team. But I'm not doing any work. If you then contrast that with an incubator or a studio, I would interchange those words. Most people who are working in studios, they have lots of people to do work, right? We have designers and developers and go-to-market and operations and recruiting, and all of those people do real work alongside the founder to try and help create that company. So think of it as action versus advice. Now, of course, we give advice too, but more importantly, we are giving the advice and we're adding in the action. So now the second question is, why would a founder think about using a studio or an accelerator, but let's say a studio specifically, versus just doing it themselves? Number one is, if you're trying to build a venture scale company, you're likely signing up for the next 5 to 10 years of your life, if it's successful. And if it's successful, wouldn't you want to increase the level of conviction you have for the idea? So that's the first C, conviction. And so you increase conviction by doing a lot of work, right? Customer discovery and product prototyping and things like that. You also increase conviction by getting a lot of perspective from people who've done it before. So you come to a venture studio like ours, and all of a sudden you've got many, many people who founded many, many companies. You've got many people who can look at it from lots of different perspectives, whether that be product or go-to-market or competitive landscape or investor interest. So you are gaining conviction that this is the idea that I want to go spend the next 5 or 10 years of my life doing. So conviction is number one. Number two is compression of time. So you could do it by yourself, but if I said, hey, go do 50 customer interviews, how long would that take you if you're doing it by yourself versus doing it with somebody who has lots of tooling and techniques to go find those 50 customer interviews? As one example of compressing the time. So normally we can do those in 2 to 3 weeks. The normal founder may take 2 to 3 months. and they may not even know where to go find those ideal customer profiles to get the voice of customers, get early adopter customers. So the ICP, VOC, EAC flow is something that we can really compress the time. So first one being conviction, second one being compression. The third is completeness. So for anybody who's listening who started a company before, you think there's a lot of crap that you have to go do to just start a company that has nothing to do with the company itself. Right? I got to go set up operations. I got to go set up payroll. I got to go set up benefits. I got to go do all this stuff. I got to find ways to get the company going. And we have people to do all of that, and not only do it, but also do it at best practice. So you now have a much more quote unquote complete company when you start versus the CEO having done that, being a CEO many times. You know, someone says, well, somebody's got to go buy a coffee maker, and okay, I guess that'll be me. Whereas in a studio model, you have someone on the operations, recruiting, engineering, DevOps, all of those things that end up creating a more complete company. And then the next is really community. So it's super lonely being a founder. And so finding a community of people who not only you can hang around with, but also have a vested interest in your success. So when we define our community at PSL, we can define it as a very narrow community. Like if you and I were starting a company, I would be somebody who feels like a co-founder to get going. And then ultimately I would be one of your board members. And so the micro community is like the project team. The slightly bigger community is the rest of the PSL people that are still part of what you're doing. The next bigger part of that community is really the people who are part of the portfolio. And so when you now back out from just an incubator studio model, is you have a small community who's your co-founders, a bigger set of people who are your co-founders, and a community of people who understand how that model works. And that's a place where you now merge back into a accelerator is part of a community, a studio creates part of a community. And if you compare that to, well, I'm just going to go bootstrap it by myself, or I'm going to do it with just venture capital, oftentimes you're not getting that level of community and support that might come along. So it's really about conviction, compression, completeness, and community.
So, I mean, that's a great answer. I mean, nothing in life is free, right? There's no free lunches. So YC, if you go through a YC accelerator, I think, YC invests an X amount and takes 7% of equity. All right. So what are the economics when a company joins PSL?
Most of the time we're thinking about that as like we are a co-founder in the company. So it's much more as if you and I were doing the company together, and that might be 50-50, that might be 60-40. Depends a little bit on how strong is the founder themselves and how much work have they done.
Got it.
And interestingly enough, when you think about a venture studio, and that's defined as somebody who has both a venture capital fund and a studio, and you could overlap those as a Venn diagram, of which PSL is one of. And so in a venture studio model, you can walk in the door and say, like, I have a great idea for X thing, and I need a lot of help and a lot more work to go realize this idea. And I really want to lean into the C's I just talked about, right? I really want to lean into conviction, compression, completeness, and the community part. And I can benefit by drawing all of those resources into this particular idea. That's a great studio kind of co-founder relationship. If you said, you know what, I kind of got it. I got my CTO, I got some other people already working on it. I've already done some customer discovery. I've already written a product, kind of the product's already going. Then I would just say, great, just talk to me as a fund investor. And we'll end up, leading around into that particular company, and we'll end up with, normal sort of seed terms type of thing. And so you don't necessarily need all of the studio work. And so we have sort of effectively two products, for the entrepreneur or the entrepreneurs. In general, teams that come with one or two or even three co-founders, they naturally kind of go toward the fund, right? Both from a cap table perspective, but also hey, we already got like somebody to do all the work. If they're a single founder that's looking to really increase conviction on that particular idea, they tend to lean toward the studio model. And then again, all the resources that I talked about, they all kind of get bundled up into what would feel like more like a co-founder relationship.
Yeah, so it depends on how much help the founder is really looking from the incubator, from the studio itself. And then you sort of negotiate one-on-one, depending on how much investment you're making on your side, right?
A little bit.
Um,
And then they tend to be two paths. Like think of it like a decision tree. And I think this is similar to other studios
mm,
in the sense that, hey, you have a venture path and that has a certain set of economics and ownership, and you have a studio path and that has a certain set of economics and effort. And they feel almost like products and SKUs to
yeah.
us, and we can back them up by saying, here's a team that used that exact same thing, and here's all the stuff that we did across all the different axes of our effort.
So when you're running a venture fund, it's sort of at least a known formula on how to measure success, right? You have a fund, you have a time you deploy in maybe 3.5, 4 years, and you calculate how much returns you're making over 7 to 10 years. How do you sort of analyze your own performance for a venture studio, especially when there's no like a cohort, like, Techstars has a 6-month cohort and YC has, summer batch, winter batch. And you mentioned that you don't have a particular cohort, so it's always running. So in such scenario, like how do you measure your own performance, as a studio?
Yeah. So the simplest way is we have quality and quantity of companies. So in a given year, our target would be 4 to 6 companies. So if we did 2 versus 8, okay, like that's one mode of how well are we doing. The second part would be the quality of those companies. And we can judge the quality of those companies by how quickly after they leave the studio, do they go raise capital? How good were the terms and how good were the investors? So that would be a quality metric on the companies. And you can imagine that we could spend all of our effort on one company and theoretically the quality is going to go up, or we could spend less effort on lots of companies. So we're balancing quality and quantity of companies across an annual basis or quarterly basis. But really, it's more like kind of annual. Did we do 4 to 5 companies? Did they get funded really well? Did they have lots and lots of momentum and traction as they entered the market, which is a proxy of that is sort of how did the funding go? And you could look internally a little bit also as to say, and how many people and how much time did we have to spend with every company to get it to that particular point? So you could just sort of sometimes internal efficiency metrics that we would think about. But in general, that's a quality quantity of companies per year is the simplest way for us to measure quote unquote success.
I think in our last conversation, you mentioned this, I think, in the studio model itself about systematic customer discovery and customer development process. So can you talk a little bit more about, what you do as part of that?
Yep, for sure. I mean, this is probably all things being equal. If you take no other advice, there's never enough customer development and customer discovery that a startup can do and a founder can do, right? Effectively, you're going to be in sales forever. Yeah. So you may as well start getting good at it. And the founder himself or herself getting good at this process and starting it from day 0 is important. So functionally speaking, what we tend to do at PSL is, first of all, we define a company in a framework that we call CVFB. And I've got a blog post which you can include in the show notes of this, but the CVFB is Customer Value Prop Feature Set Business Model. For people who are familiar with business model canvas, this is sort of like a simpler version of that. And you could, if I filled that in, you could say for this particular ideal customer profile who needs this quantified value proposition, our feature set or minimum viable product is X and our business model is Y. So CVFB is a short description. We then define our ideal customer profile, ICP. And then we use a lot of different tools and techniques we have as for any given ICP, we are trying to drive to lots of VOC or voice of customer. That is tracked in a Google Sheet or a Coda Doc. And every week we are going through is like, how many VOCs did I do? And if I had to restack my VOCs into who's most likely to buy and least likely to buy, why? So this is really in customer discovery mode. It's like, does anybody care about this thing that we're trying to do? And can we find them? Then when we say the difference in customer discovery is, does anybody care? Will they listen? Will they take our call? Then we move into customer development, which is sort of this stack ranking, which is sort of like, okay, 10 people we talked to, 3 of them said they really, really want a solution for this. And they said they would pay us what we think we want to charge. And what is what do they want to pay? Are they clear about value prop? And how does our MVP fit into that? So going back to the CVFB and stack ranking, really then it's ICP, VOC, EAC, early adopter customers. So of all the people we talk to, like, who are the first ones we really want to get? And then we start to build our product against that set, right? That subset. And in theory, you may have your number one, and then 1 through 3, and then 3 through 5, et cetera. But that process of ICP, VOC, EAC is something that we do, we're doing all the time. At any given time, we're probably trying to attempt that on 5 to 7 companies that are running in the studio at some point in time. And we're very systematic about that. We have built a lot of process and tools, and we have lots of different techniques, whether that's a enterprisey type of product or a B2B type of product, or even a B2C type of product, different techniques and strategies for that, and running that weekly sprint process, at which point every Friday afternoon we say, okay, how's this company doing? Getting better, getting worse? Is it still the same CVFP combination? Because sometimes you change that, right?
Yeah.
Any number of those things may change. And if it's still generally the same, okay, how many VOCs did I do this week? How many are planning for next week? And what are the additional goals in addition to the customer discovery work that we may add to that particular level of understanding for a company?
I mean, the whole process can be really useful for different types of founders. I can see why, because you initially have a thesis about a problem, but you don't really know out there in the market whether it's valuable or not. And I think this is a great way to sort of discover whether it's worth pursuing. Are there any instances that you remember where you thought, okay, this idea might not work, but let's go and inquire and see if there's actually market for this, and found surprised that there's actually market for this? Are there any instances like that?
Based on the way the studio model works, or our studio model works, we sort of run in this, we have an ideation stage, which effectively ends in kind of that CVFP. We have this validation phase, and what we're trying to do in validation is there a venture scale opportunity where we can actually go find customers who want this problem solved, and that we can see enough of the market, competitively or otherwise, that this feels like a good idea. At that point in time, we move it to the third phase, which we call creation. And at that point, we now have an entrepreneur leading it. Whether we found is our idea, we go find this potential CEO, it's their idea, we're evaluating, okay, we're going to go do this idea or try to do this idea with this person. At that creation phase, it's still not a company, it's still just a project in the studio. But we now have a leader, and we're starting to really orient behind that leader and their vision for the project, even if we had inspired it in the first place. The end of creation is the day the company is founded. And then the next phase is called the spin out phase. And that ends the day this company is VC funded. So it's ideation, validation, creation, spin out, scale up. And in some ways, because we have that process, we are going from ideation into validation with a hypothesis, and we're either confirming or denying that hypothesis. But to even get to the creation phase, we have to have a pretty strong belief of it's for these types of customers. And we probably already have people who are leaning in as an early adopter customer. And that is why it pulls into creation. And then you're converting those people into early adopter customers in the spin out phase. And then you're raising capital against that early customer traction. So the process itself means effectively there's not a lot of pivoting in those phases, right? You could pivot a lot in validation, but you tend not to do too much unless something massively changes in the creation or the spin out phase. Now, certainly companies get into, we've raised capital. Hey, our first hypothesis, we got our first 20 customers and we couldn't find any more. Uh-oh, what happens there? Now, you didn't get your first 20 customers until you'd already raised external capital. We have had those kinds of cases, and I think any VC has. But in most cases, as it gets into that spin out phase and raises external capital, there's not a lot of pivoting because we did all that pivoting part back in the validation stage.
But you might see more ideas. I mean, you might discover ideas that you might have not thought of validation, right? When a new entrepreneur comes, do you have a list of ideas that no one pursued, but we think, they're out there, someone to pursue?
Yes. So let's say that we had an idea, and I'll say in the ideation sessions, they started sort of like hypothesis and categories, for lack of a better description. We think there should be a co-pilot for doctors that does X. And we think that's a good idea. And we have the beginning of kind of a market landscape. And we think we know maybe some people we could sell it to. So we have like I'll say an idea of a company, and which is sort of somewhere between a category and a hypothesis, but it might not even be a CVFB at that point. At that point, we made a founder who says, I would love to work with you all in the studio. I have healthcare background. That sounds pretty interesting. Let's start working on something. And at that point, that's really that moves into ideation. Then we do that ideation to validation sort of work. And so we have some ideas that we got very excited about, and we have not yet been able to find the founder. So those are ones that are already validated, and we just haven't quite found the right person to lead it yet. And so those sit on the backlog, and we probably have 3 to 5 that are kind of that nature, and we probably have 30 to 50 kind of categories or attempts we've had at an idea that hasn't materialized yet into a company. And I could give you plenty of examples of those.
Do entrepreneurs come to you and like say, hey, I want to do my next company, but I'm not really sure where or which category to pursue? And like, do you guys show the list of categories you want to pursue and like say, if you're interested in some of these, then we can pursue? Like, does that happen?
Absolutely. And if you think about it as a founder, you want to zero in either on 2 axes as a founder. So let's play that out as you did. So one is, I would say, like, what do you just get excited about? Mm-hmm. Like, what category are you excited about? Financial compliance? Are you excited about healthcare? Are you excited about the environment? It doesn't matter. Like, pick a category. And then we can sort of filter our ideas into that category. The second axis is, where do you have, based on your background, strong founder idea fit? Oh, well, I just worked at Xco and Yco and Zco. So therefore, independent of the idea, I would already have likely a strong founder idea fit for something like this. Like mine might be business productivity or health. Now, I may be really interested in business productivity and not in health, even though I could probably have a reasonable founder idea fit for a particular category. The third way that we tend to encourage founders to answer this question is, what's the why now moment for you, either by market or by technology? What is happening right now in the world that means you should be in this particular category? Climate, health, generative AI, whatever. So a technology orientation or a market orientation, which starts to get people excited. I usually give them that homework. I was like, oh, what are the 5 bullet points of why now for whatever category of idea before you actually get to the idea itself? So those are 3 different ways that we tend to help a founder who comes in with your perspective, which is, I'm ready to do my next thing. I want to be a founder, CEO of a company. I'm not quite sure yet of the category or the idea inside the category, and whether we already have an idea in that category or we try to narrow in by the 3 ways I just described, which I think is good for any founder anyway, because you're going to have to do that when you sit in front of a VC. You're going to have to answer the question of, how does the founder idea fit come together? Why me? Why now is that third axis. And why am I so excited about this particular category? And I'm just, can't sleep at night because I think about how cool it's going to be to build a solution for this problem in this category at this point in time.
So what are some of the companies that came out of the studio and are doing well?
Let's see. I can pick a few, and they'll start to suggest a theme, as it were, for the studio. So one like Boundless. So Boundless is really automating the process of immigration. So for all of us who are file taxes, we all are probably quite familiar with something like TurboTax, but there wasn't something like that for immigration. So when you're filling out all the paperwork, you want to make sure that you've got all the right things and all the right boxes, that it's all very consistent, and that you know where the thing is in the process. So Boundless is, in a simplistic way, TurboTax, but for immigration with a primary focus on the United States. That company is going very well. SecureSave, that is a company that is creating emergency savings plans for companies and their employees. So if you think about an employee that may be on the lower end of the wage spectrum, they may be only one car breakdown away from bankruptcy or not having enough emergency savings. And so SecureSave is an automated way for companies to offer emergency savings plans the same way they might offer health savings plans for someone in a company. Otis is a brand new company that we have that just sort of spun out, and Otis is automating the process of discovering the best prices for prescription medication. So today the variability in prescriptions is very high. There's all different kinds of prices for the exact same thing depending on when you buy it and where you buy it. And for people who may have to pay for those prescriptions out of pocket, it's very difficult. And so we effectively do an automated search looking for the best price and the best location for any medication, all done via mobile interface. Think of it like Kayak for prescription medications. So those would be just three off the top of my head, which are interesting sort of automations of things that humans would do normally. And the more automations we do, the better the machine learning underneath is at both predicting what is the next step, but also getting better accuracy for the outcome, whether you're trying to, save the right amount of money, or you're getting the best prescription, or you're ultimately wanting to get through legal immigration process.
So slightly shifting the gears. You've been an entrepreneur, for more than 5 companies. You've seen a lot of ups and downs. From the internet boom to I think the 2008 crisis to what's happening the last couple of years. So lots of, talk about recession and, the state of venture being down. How do you think, or how do you tell entrepreneurs to think about, raising venture right now?
Well, I've been through I started companies in 95. That's the internet wave. I started companies in 2008. I'll call it the mobile social wave. Now we're starting companies and call it in 2000s in the cloud wave. And so I've been doing it enough times through almost every major technology shift. Certainly, I believe that this is a major technology shift. But in terms of the macro point, the entrepreneur just has to be aware of 2 or 3 things. One is the general climate positive or negative? In this case, we would be much more negative now than we were before, meaning general venture climate. Like, are people writing checks really quickly or sort of slowly? And now we're just in a slower. Is it going to get slower than it is now? I don't know. Is it going to get faster? I don't know. But it's not going to change dramatically probably in the next 3 months. So point one is just be aware of the faster or slower nature of the macro cycle and then the more micro cycle. Second point would be every category has sometimes more or less investor interest. So if you happen to be lucky enough to be building something in the hot categories, good for you. Should you change your company to be in the hot category? Absolutely not. You just have to be aware that your particular company is in a hot or a less than hot type of category. Third is that you have to be very cognizant about when and how you think that you're going to need to raise money. So most entrepreneurs, especially first timers, are not very thoughtful about, I'm going to raise X amount of money. It's going to last me Y amount of time. I'm going to achieve Z amount of metrics. And that's when I'm going to have to go raise money again. So the micro of the company is much, much more important than the macro, because you can't control the macro. What you can control is, hey, let's say I'm planning on raising money in September. And in that September window, it's likely to be harder than it was 2 years ago. And it's likely harder or easier for my category. Doesn't matter. Your answer to that question then says, am I going to have 30 investor meetings, 70 investor meetings, or 150 investor meetings? You can suppose that answer, and then you just have to think about how do you factor your time appropriately. Because you can't really choose what business you're in. You're still in the same business. You can't control the macro issues. You can only control what you can do given the macro issues or the category that you're in. That's all. That said, is every good entrepreneur should be saying, who's the best possible 5 investors to lead my next round? Do I already know them? And am I starting the dialogue before I need to actively raise money? So we talk a lot about active or passive fundraising. And before you need to raise, you should be in passive fundraising, talking to 1 to 2 investors every month who are good enough to lead your next round, who like the category they're in. They're going to give you a roadmap to success. So if you're raising money and starting in September, you should be doing passive fundraising right now and forever, actually. But then when you hit September, you'll move into active mode. Now you're talking to 5 or 10 investors a week. not 2 investors a month. But the difference between active and passive fundraising mode is really important. And you may, if you're in a less good category or you're doing less good as a company, relatively speaking, you may have to add 3 or 4 investors while you're doing passive, because you're just going to need a longer list by the time you move into active.
Yeah. Yeah, I think you're right, obviously, but we do see people changing categories because AI is hard. So I want to talk a little bit about, what we are seeing with AI. And I think you mentioned that you do think it's a step change phenomenon that we are seeing AI. Talk to me a little bit about how, as a studio or just as a investor, how you're thinking about what's happening in AI right now.
Well, I think about it like all of the other major platform shifts. I mean, if you're a company in 1997 and you don't have an internet strategy, I mean, it's just dumb. If you're a 2008 company, you don't have a mobile social strategy, it's just dumb. If you're sitting here today in 2023 without at least an awareness of a thoughtfulness for what might I be using different components of AI to advantage my company or my customers, it's just dumb. Now, if you don't have any of that, then you should start to be thinking, you should have been thinking about it before. And if you have some of that, you should be thinking a little bit harder about it, because the technology shift is there, and the companies who understand how to apply appropriately these types of technology shifts will have an advantage. And I believe that the same way as you would say a mobile advantage or a social advantage or a cloud advantage or an internet advantage. So the delta is between what am I actually doing, what could I do in the near term, and am I on the this is just additive to what I'm doing, or this is core to what I'm doing, is for the entrepreneur to figure out themselves. And they'll strategically have to say, you know what, we have to throw away all that other stuff we were doing before. We have to go do this because it's such an important part, or our category or our market or our customers really want us to be on the leading edge, the bleeding edge of that particular wave. And that's a choice for the entrepreneur to make, and the entrepreneur with his or her investors and his or her team to make based on their own assessment of the market. And we certainly are making those assessments as well for a company here. I call it sort of slide 7. So any company who walks in here and doesn't have a slide 7, which is how are we taking advantage of the newest, best technology to advantage our product or our customers in our market, like everybody needs a slide 7. How much credibility you have behind slide 7 and how much that is woven into every slide that you have on the product side or the go-to-market side is up to the entrepreneur. But you must have at least an awareness of, because otherwise, like, wait, this is a very, very important point in time that is an enabling set of technology that we are somewhere along the continuum of aware of, prototyping, testing, have already integrated, have already productized, and is now a leading feature of what we're doing, regardless of what category you're in.
There's also this interesting dichotomy with AI is like the larger companies are moving pretty fast when you compare with other trends that we've seen before. And we're also seeing at the same time, OpenAI is a startup in itself, like which sort of unlocked the entire hype around AI. What do you think about like this, will big companies sort of capture the entire value, or like newer companies, there's space for newer companies coming into the space?
Oh, there's space for everybody, right? I mean, space for everybody for sure. And so the good news is that everybody is investing time and effort in this. So that means we're all learning faster. Right? Every day you just pay attention to Product Hunter, you pay attention to the next big co who's launching their thing, and then you go try it. And I won't pick on any big co per se, but like go try one of their agents and say like, well, is it really actually good? It's okay. Better than not being there. And I can see where they're trying to go, but they're not actually that great yet. And so any place where it's not great is opportunities for startups. There's also a lot that are, when you think about big co's, they tend to be very selfish on their own platform. So let's say that you were building a ChatGPT add-in for email. Okay, well, Microsoft might have theirs inside of Outlook, and Google might have theirs inside of Gmail, but the Gmail one is probably not going to work inside of Outlook and vice versa. So if you're the cross-platform add-in for email as a as a way to make people who do email more efficient, and the more you can get on two different platforms, the smarter the software is going to get. The cross-platform nature is something that's quite interesting. Let's say you're doing something that is generative around design. So I'm working on Figma and I'm working on Webflow. Okay, so is Figma going to do Webflow and vice versa? Not really, right? They're going to compete with each other, but the person who says, listen, I can support both of them in the way that I want to do it is important. And then it's not just about the technology. There's a lot about the go-to-market and how you get it, get it in the hands of customers. The good news is that we will have lots and lots of agents delivered all up and down the stack, whether you're two people in the garage doing something or you're Microsoft, Amazon, Google, whomever. They are going to be investing in this for a long period of time, in my opinion. And therefore, some of the foundational models just get that much better. The learning gets that much better. Going back to my slide 7, if you know that that's happening from the smallest companies to the biggest companies, how can you even imagine competing if you're not at least aware and experimenting with this type of technology?
Yeah.
But we both worked at large companies. It takes a long time for them to go make a lot of choices.
Yeah.
And the opportunity technically may exist, but the opportunity to productize, to ship, to monetize, to price and package, and there will be plenty of innovators' dilemma happening along the way here for larger companies.
Yeah, I think one difference that I see versus previous shifts versus this shift is especially why large companies seem like they are, more faster than small companies is because, like, let's say when you are in the mobile era, like catching up to mobile required a sort of different set of skills and different set of technical stack. And with cloud and with other technology improvements in the stack, all the big companies can ship much faster than they used to, like when in the cloud era or in the mobile era or in the social era. So this time it feels that it's much faster, plainly because the ability to ship faster is there even in big companies. I think that's what we are seeing right now, but there's still the other factors, like you have to actually make decisions. There are a lot more meetings in big companies than smaller companies, right? It takes a lot more time to actually make decisions, as you rightly said. So there's still differences, and there's advantages of being a startup versus, a big company, and there's still a lot more things to consider and innovate. And I think there's also a shift where, a lot of things might not look the way they looked before. Like email might not have to look like Gmail. Like design might not have to look like what Adobe is doing. Like you can come up with different modalities and form factors that might be completely new for different categories. So I think there's an opportunity for startups to think ground up, like, okay, let's scratch everything that's happening, because big companies will think in an additive sense. We can add this to existing products, add this to, our existing solutions. But I think as a startup, you don't have the baggage of that. And I think that's where all the interesting things can come from startups. But we're almost at the end of our time. So I want to ask one last question. And I ask this all my guests is, what are some of the interesting, people, books, blogs, or tools that you follow that necessarily not other people follow?
Well, it's hard to know what not other people follow, but let's see, a few that I've really enjoyed. So Brad for sure, and the books that Brad has sort of published, and I follow Brad and Fred Wilson's blogs a lot. I've really enjoyed Invest Like the Best. And my partner, Ben Gilbert here at PSL, does a podcast called Acquired. And I love Acquired. And I think he and David do such a good job on that. And I've of late have really enjoyed Lenny's podcast, All Around Growth. And I think that thinking in terms of growth and primarily around product and go-to-market growth, but what Lenny is doing, the people he's interviewing on Lenny's podcast is something that I've really enjoyed of late. And all things being equal, if you can find better ways to acquire customers than the people who have the same ideas, you can create an advantage. And so those are some of the podcasts that I've enjoyed of late.
Yeah, Lenny's podcast is pretty good. Thanks, Jia. Thanks for being generous with your time and joining the show. and really appreciate it.
You're welcome. It's great to talk with you.